Unit 1, The Financial System, Lecture 4, Financial Instruments and Markets, Part B. In order for a financial market to operate effectively and efficiently, it has to have certain characteristics. Provision of information is one of them. Information should be provided in a timely and accurate manner. Internal efficiency, which relates to cost, transaction costs in particular. You want those costs to be as minimal as possible when compared to your trade volumes or the value of your trade. Provision of liquidity. Now, liquidity, by definition, is the ease with which an asset can be converted into cash at or near its market price. In other words, quickly and cheaply. Liquidity requires marketability, price continuity, and market depth. You want external or informational efficiency. In other words, any new information that comes into the market must be absorbed into the price as quickly as is possible, because you want investors to be trading on the most relevant information, and those must be incorporated into the price. So when we talked about the characteristics of a good financial market, we mentioned liquidity, and for liquidity in the market, it required marketability, price continuity, and market depth. Now, marketability relates to the security's ability to be sold quickly. In other words, if you decide to sell your shares in the market, you want the time between placing your shares on the market and when they are sold to be as short as possible. Do you want price continuity? So you don't want prices flip-flopping all over the place. You don't want significant changes from one transaction to another. But that is obviously depends on new information. If substantial new information comes into the market, like we have seen with Steinhoff and Capitec, then that will have a significant impact on prices once that information is in the market. But once that information is in the market, prices should once again stabilize, and you should have price continuity. Market depth. And this relates to large trade volumes. So if you want to put a large quantity of shares into the market, you want that to significantly impact on the prices of those shares. So you want the market to have the ability to absorb these large traders, and as such, you want it to have as many buyers and sellers as possible willing to trade at that price above and below the current market price. So we have seen these participants before, so we're looking at the participants now of financial markets. And because the financial market is part of the financial system, there are participants we've seen before. So there are lenders, the individuals who buy or invest in securities. You have the financial intermediaries. They facilitate or expedite the flow of funds from lenders and borrowers. And as such, they are issuers and buyers of securities and other debt instruments. And you have the borrowers who issue securities. Some other participants to the financial market includes the dealers, or sometimes referred to as jobbers. They buy and sell securities for their own account. Financial advisors. They provide investors with recommendations, guidance, or proposals for their purchase. And they provide advice to corporate borrowers and other issuers of securities. And then we have the brokers. We've met them before. They act as conduits between lenders and borrowers, or buyers and sellers in return for commission. And we met the brokers when we talked about direct investment. So here are some market participants we may not have seen or talked about very much before. We have speculators. Now, we're all aware that speculation is an activity which has a lot of risk, and you can get very high rewards if your risks pay off, but you can lose everything if it doesn't. So in the financial market, speculators attempt to make a profit by taking a view on the market. If they are correct, they make lots of money. If they are not, they could lose their shirt and everything else. Arbitrages. Arbitrage is the process of making risk-free profits. So a very, very simple example. You've just recently bought a car for 100,000 Rand. Somebody comes along and says, oh, I like your car, and they're willing to pay you 120,000 Rand. You've just made 20,000 Rand in profit risk-free. So it involves buying and selling the same asset in two different markets. Now, in the capital market, arbitrageurs make profits by exploiting inefficiency in market prices. So they'll look for assets which are incorrectly priced or differently priced in two markets. And then they will simultaneously buy the asset in the cheap market and sell it in the relatively more expensive market, and they will make a profit from the difference in prices. But they have to be mindful of transaction costs. Hedgers, literally people who sit on the fence. No, not. In the capital market, hedgers are people who are exposed to the risk of adverse market price movements. So they may have bought a share that they're frightened is going to go down quite significantly. So they will hedge or mitigate that risk by using hedging instruments, and a derivative is a type of hedging instrument that can be used. Now, the last type of market participant we'll look at today is a market maker. Market maker stands ready to buy or sell certain securities at all times. So they quote both a bid and an offer price. The bid price is the price at which they are willing to buy an asset, and the offer price is the price at which they are willing to sell the asset to the market. And the difference between the bid and offer price is referred to as the spread. The bid price is the lower price, the offer price is the higher price. And depending on how the market looks and the positions that they currently hold in their books, they will adjust their bid or offer prices accordingly. Now, when looking at the different categories of financial market participants, they're not necessarily mutually exclusive. Now, mutual exclusivity means that each category is completely separate from another category. Not so with the financial market participants, because, for example, a financial intermediary such as a bank may be a financial advisor, a market maker, a dealer, a broker, a speculator, and even a hedger. So all financial intermediaries or market participants can take on more than one role.